G7's recent decision to implement a price cap on Russian oil is not new. Discussions have been going on for months. As you know, the US and its allies have been sanctioning Russia since the war in Ukraine started earlier this year. The price cap will be in tandem with the EU's sixth sanctions package, which will come into effect on December 5th. The package includes a ban on all Russian crude oil by sea into the bloc, and there are also restrictions on providing insurance. It is not possible to fully cut the flow of Russian oil into the global market. After all, crude oil prices are high, and many nations, both developed and developing, are facing high inflation. The G7 hopes that the price cap will ensure that countries can still buy Russian crude and petroleum products, but Moscow will not be making a profit on it. US Department of Treasury's Assistant Secretary for Terrorist Financing, Elizabeth Rosenberg, said that the price cap policy is an important tool to counter inflation. US Treasury Secretary Janet Yellen said that the price cap on Russian oil exports in the $60 a barrel range would likely be sufficient to reduce Moscow's energy revenues while allowing profitable production. The G7 is hopeful that this will work as these countries control nearly 90% of the global shipping insurance market. Russia requires a huge amount of vessels to export its oil. But the struggle is not finding the tankers, but to meet the insurance. And herein will lie the challenge for the consumers or the countries who want to buy crude from Russia. Russia has been upfront in its strategy. Russian Deputy Prime Minister Alexander Novak warned that the price cap on Russian oil can have a detrimental effect on global oil market. Russia will not make supplies to countries that will set the price cap. The price cap will allow Russia to sell its crude oil and petroleum products at the level the lid has been put or below it. This is seen as the most effective way to keep the oil market well supplied and lower energy prices. But OPEC Plus decision to cut production might keep prices high. The capping does pose many challenges. It will have an impact only when there is a supply crunch in the global market. The price cap would be successful only if consumers like India and China back the deal. We don't know yet their plans. For India, there's a lot at stake. We import more than 80% of our energy requirement, and an increase in crude oil prices will impact the economy. If India is able to procure crude oil from Russia at a discount of $20 or $30 a barrel, it will be of great help to tackle its inflation. India has become Russia's second biggest oil plant after China, even as Western countries have reduced purchases from Moscow. The government's stance is a test of how effective the price cap will be. Reports suggest that India might not join the plan.